I think we can go ahead and get started. Thank you for joining us on this webinar about navigating the insurance marketplace. I feel that as I'm working with my clients in estate planning, we also kind of end up helping them to navigate some insurance issues, or we get a lot of questions, and in those cases, I generally refer those questions to those clients to some of our kind of trusted advisors in the insurance area. So I'm happy to introduce Erin Ardleigh and John Pugliese. Erin and John, do you want to introduce yourselves?
Of course, go ahead, Erin.
Thanks. Hi, I'm Erin Ardleigh. I'm the founder of Dynama Insurance. We're an independent insurance brokerage based in New York City, but working with clients nationwide. And I founded my company because I'm passionate about making sure that clients feel informed and educated about their choices in the insurance marketplace.
Great. And my name is John Pugliese. I work with Alliant Private Client. Alliant is a top 5 national insurance broker in terms of size and scale, and I work on our private client division, specializing in working with successful families and individuals on their property casualty insurance needs. So their homes, autos, collections, umbrella policies, you name it. We work nationwide, and we work with a number of insurers as we are an independent broker. Thanks for having us today.
Sure, sure. And I realized I didn't introduce myself. I think probably whoever's on this webinar knows who I am, but I'm Shannon McNulty. I'm an estate planning lawyer and the founder of the Village Law Firm, and we help New Yorkers protect their loved ones, their values, and their legacy. And so I thought this could be a helpful webinar for anybody who has questions about insurance. And if you have questions during the program, you can definitely just put them in the Q&A or the chat, and we'll get to them either during the webinar or afterwards if we feel like it would be more appropriate. Alrighty, so you both mentioned that you're independent brokers. What does that mean? Can you explain what that is?
Sure. So when it comes to insurance, many people don't realize that there's really 3 ways, especially on my side, that you can purchase insurance. You can go to an insurance company and work with an agent that works at that company. And the downside there is, of course, if you ask that agent, who's best, they're going to say the company I work for. They're probably not going to tell you about 20 other companies that may or may not have more appropriate products for your needs. You can also go online and use websites to see lots of different products and prices, but you really won't have any understanding about why one product might be better for you or not. Or you can use an independent broker. An independent broker is someone who is contracted with multiple companies, and the broker's job is to be your advocate and to help you understand all the different products and options and to figure out which one is best suited for your needs. I always say there's no one company that has the best products for everyone in every situation. So the best way to find out what's best for you is to have an advocate, which is an independent broker.
Okay, thank you so much. Yeah, that definitely, we have clients who sometimes they have a particular health issue. They may be pregnant, and we've had so many times where clients will say, I can't get coverage because I'm pregnant. I can't get coverage because of this. And I'm like, well, you need to talk to Erin first before I accept that answer. You will know if whatever issue that you're having, maybe it's better to wait, or maybe there's a particular policy carrier who will still cover you even though you have that particular issue. So I know she's like, oh, if they have a heart issue, this is the better, the better company for you. So it's a really, really well worth it. And I don't think you're really paying any more if you use a broker than if you go online. And I think you can even, Erin or somebody, an independent broker can help you navigate of how much these policies should be, and also what is the quality of that insurance policy as well. If if there's a claim, are they going to pay out quickly? Are they going to kind of put up a fight? You could have like a really cheap carrier, really inexpensive carrier, and then it can be very expensive for you or your family if something needs to be paid out. So those are things that I think sometimes people think, oh, it's like insurance is the same. It's just, I just go and find the cheapest option. And that's the one I should take. So I think it's important to understand there's a lot more that goes into that.
And sometimes the cheapest option can be the best option, but it's just important to understand if there's something that could maybe even be a few dollars more that might be better for you. And just to cap on what you said, there is no extra fee for using an independent broker. The price is exactly the same, whether you go through a company directly, go online, or use an independent broker. So if you're working with someone like me or John, you're getting our decades plus experience, our personal service, our team's help, and there's no extra charge for it. So it really is a win-win. Of course, that's why attorneys like Shannon tell their clients this little secret.
So
And I'll just throw in, my additional 2 cents here. And, insurance is highly commoditized in some cases. You can't turn on the news or the TV without seeing, some type of insurance commercial or something like that popping up. And, I think that's been a disservice, to the industry as a whole at times, just because it is all about price in some cases. And as Erin alluded to, sometimes the cheapest policy can be the right fit, but we don't know that until we talk through those options. And I think for us, especially on the property casualty side of things, is our job is to tell your story in the most favorable light. As opposed to just being a number that is being punched into a website where they know nothing about you and it's just an algorithm that's spitting out a number, as opposed to your individual needs where we're telling your story on your behalf. We're your advocate. So anyway, there's quite a few advantages, and hopefully that resonates a little bit to everybody on this call.
Great. Okay, so let's talk about life insurance. I think that's one of the most common types of insurance that we work with anyway, in terms of the estate planning aspect of things. We help put your documents in place, making sure you have a plan, but I always want to emphasize that if there's sort of very little or nothing in the to go into your trust or whatever, then that can be a problem. And also, I've just seen so many cases where one spouse has passed away and it causes a lot of problems. Like they didn't have a very good life insurance policy, and at a point where now maybe they're a single parent, and also now they're under financial strain, immense financial strain. So it's kind of the worst trifecta of a situation that you can have. So it is, I'm always telling clients, like, it's definitely well worth it to have life insurance. But Erin, do you want to add to that?
Sure. So, essentially you need life insurance if someone else would be financially hurt if you were to pass away. And of course, for many married couples, it makes sense to have life insurance, and absolutely for parents. I joke that when you leave the hospital with the baby, it's too bad we can't just tuck a policy in there in the bassinet, because it's so crucial for parents to have life insurance in place. And something is better than nothing. So you don't necessarily have to get all the insurance you need, when you first get married or first have a baby, but you do need to get at least something. So we always recommend life insurance for income replacement, family protection. It can also be used for, planning for estate taxes or creating a legacy for children, grandchildren. It can also be used to help maintain something illiquid that's in your estate plan. If you're leaving, the family home or some commercial real estate or an art collection to your heirs, do they need liquidity to pay for the insurance and the upkeep of that asset that you want them to be able to maintain rather than sell? So that's another reason for life insurance. And we often see, maybe you have one child in the family business and one child that's not. Life insurance can be used to even out that inheritance scale, as we like to say. But really, the main reason is just protecting those that you love, making sure that if the worst thing that happens, at least money is not a stress.
Great. And I think the next question that a lot of people have is, how much life insurance do I need?
Sure. There's a lot of misinformation out there about this. It's, 10 times income, or it's what your friend has. This is a very personal question. There's no app that is going to spit out the right number. I always tell people there's a little bit of math and a little bit of emotion that goes into figuring out the right number for you. So we usually look at, what are you earning? What are you spending? What would your family be spending if you weren't around? And what large debts or obligations do you want paid off or essentially prepaid if something were to happen to you? So for many clients, that is the mortgage or college for children. So these are all things to think about when you're coming up with your number. A good insurance broker or a good financial advisor and a good estate planning attorney, of course, can help you walk through those questions in more detail to figure out your number. But another thing people sometimes forget to think about is the emotional cost of losing a loved one. Even if someone has a spouse that doesn't work, I might say still have a $500,000 to $1 million, or at least 1 year's income. Because if something happens to your spouse, you may not, crush it that year in the office, right? So also the cost of, if you have a spouse who's a caretaker, there's a cost to replacing that care that they were providing for free if God forbid something happens to them. So those are some of the questions to ask when you start to think about your number. And I definitely advise getting help from a professional to come up with the right number for you.
Great, thank you. Yeah, definitely. I think a lot of times people underestimate the value or the cost of just the everyday helping with the kids, getting them to be them to be where they're supposed to go. Just everything of what is entailed in parenting. And if one spouse, whether they were working or not, you have to include not just like whatever they were making income wise, but also whatever the value is that they were adding in terms of like, are you going to have another nanny, or you're going to have to, hire a lot more a housekeeper or something like that, just to pay for or cover those things that that the other person was handling or helping with.
I think my husband would need to hire a couple of people if I wasn't around all of a sudden.
There's no replacement for anything. Okay, so let's talk about the different types of life insurance. There's a lot of different kind of products on the market that you hear about. Can you tell us a little bit about what are the different types of insurance and how we navigate that?
Sure. So very simply put, there are two types of life insurance. There's term insurance and permanent insurance. Permanent insurance is designed to cover you for your entire life. Policies today go till age 120. So these are policies that you buy if you know that whenever it is you pass away, you need a benefit to be paid. This is usually for estate planning and legacy planning. These policies are more expensive and they're not where most people start. Term insurance is temporary insurance, is designed to cover temporary needs. If you have a child, it might be hard to believe, but at some point that child will be out of the house and hopefully off the payroll. So term insurance is appropriate for covering you for 10, 20, 30 years while you have a financial obligation. If you have a 30-year mortgage, you might have a 30-year term policy. That means your policy is going to provide coverage for that time frame and then end. So at some point you'll pay off that mortgage. At some point you'll retire with investment assets and not have income that people are depending on. So term insurance is something that most people need, that is inexpensive. And again, it provides temporary coverage for a certain number of years or certain term.
Okay, great. So, and I think I just want to mention, because I think you had mentioned this to me at one point, of how to think about term policy versus, permanent life insurance policy. And because a lot of times people say, well, I get money back, like term is just a waste of money, right? I'm just throwing money away. I don't get anything. It's not accumulating any value in there. And I think thinking about it as, well, it's kind of the same as like your homeowner's insurance, right? It's kind of like you don't expect your homeowner's insurance to be accumulating value. You just hope that you never have to use it because you hope your house doesn't burn down.
Right. Yeah, I think Especially like the analogy I'll use sometimes, especially with New Yorkers, is it's sort of like renting versus buying. So yes, if you rent an apartment, you're not accumulating value. You're not going to get to sell that apartment one day, but you're also, if there's a leak, you're not on the hook for it the way the owner is, right? So you have less of a financial commitment, and you're not using it as an investment vehicle. You're hopefully just paying as little rent as possible for the apartment that works for you. Whereas permanent insurance is more expensive, more of a commitment. Yes, there will be a payout at some point, but if you live a long, happy life, ideally your insurance is not a great investment. That means everything went well. Insurance is only a good investment if there was something bad that happened in life. And yes, you have term insurance, not because you expect it to be, an investment, just like you buy renter's insurance or homeowners insurance, hoping you'll never need it, right? If your house never burns down, you're not unhappy that you paid for, property insurance. And same thing with term. You get to the end of that 30 years, oh, well, you threw that money away. It's because life went well. It's really there for those God forbid sort of scenarios. It's not there to be an investment vehicle.
And let's look at the different costs of policies and different carriers and what that means.
Yeah, I made this slide just to simply show the difference between different companies. So this is a client in New York who actually had Mass Mutual insurance policies. He had gone to someone who worked at Mass Mutual and gotten quotes. And then we did a comparison where we looked at every single company that was rated in the top categories financially in New York State. And we showed him the three best priced companies. And you can see they're all less expensive than Mass Mutual. So these are term policies. They all more or less do the same thing. In this case, we have 10 million 20-year term, 10 million of 30-year term. That just simply means you're paying this premium every year for the 20 years or the 30 years. God forbid you passed away, 10 million is paid out. If you get to the end of the term, it goes away. And you're essentially paying a lot more for one of these companies. That's just showing you the value of comparison shopping, that there is a significant difference. And sometimes one company could be almost double what another is. So this is really just to illustrate, you comparison shop when you go to the grocery store, you probably comparison shop when you buy some clothes or a new car. You also need to comparison shop when it comes to life insurance. You might have these products for far longer than you have that shirt or that car. So you need to apply the same idea of comparison shopping and looking at the prices.
Yeah, because that looks like it would really, it's like, it could be a difference of 6,000 a year over 30 years. That's a lot of money.
Right.
Okay, so this is sort of a bit of a comparison. What you want to tell us about
Yeah,
what
so this, I would say term insurance, we talked about why it's necessary. Another reason that clients that are accumulating wealth should think about term insurance is as a placeholder for permanent insurance. As you and I know, Shannon, a lot of people in their 20s, 30s, and even 40s aren't ready to do full estate planning. They don't know what the next 40, 50 years of life looks like. However, a lot of times when clients come to me in their 60s and 70s and they say, my attorney told me that I need permanent life insurance. And then I tell them how much it costs at that age. And it's very hard for them to wrap their mind around paying that high price. So one advantage of term insurance for someone who is likely to accumulate wealth, likely to be doing some sophisticated estate planning, is to have term insurance that you can convert to a permanent policy later. The advantage of this is if you convert, the pricing will be based on the age you are in the future. So we can't keep you young forever, but the health rate you got today. So I had a client who, his name is Jason, and at 34, he could have bought $5 million of permanent insurance. It would have been $35,000 per year, or $5 million of 30-year term for $3,300 a year. So he said, I like the $3,300 better. Now, this helps him for the next 30 years. But what if in 16 years, when he's 50, he wants to have some permanent insurance and maybe he's not as healthy? If he was a standard or average health rate versus a super preferred or super healthy health rate, then the price would be different. So we just showed you, if we fast forward into the future when he's 50, if he went out and tried to buy new insurance, he wasn't as healthy, it would be $78,000 per year. But if he was smart enough when he was 34 to get this convertible term insurance, we could convert that and lock in that super preferred, really good health rate, his weight when he was 34, and it would be $62,000 per year. So that would save him almost $17,000 a year every year going forward. So this is really just for clients that say, how much insurance do I need? Why am I getting the insurance? This is just one more idea of saying, have a little extra term insurance with an eye towards the future to just give you some options when you do that more sophisticated estate planning that's likely 50s or 60s later on in life.
Great. So I think the message here is that if you get the convertible policy, you can eat as much as you want and jump around and buy and not
Yeah,
have to
if you're planning on taking up, chain smoking or hang gliding or race car driving, definitely get some convertible term insurance.
Alrighty. Okay, so let's talk about what permanent insurance is. So there's all of these different types of insurance that I guess fall into this category of permanent insurance.
Yes. So it's really important, again, when it comes to life insurance, to comparison shop. And one of my number one tips is don't buy what you don't understand. I'll have clients come to me 5, 10 years after they've bought a policy and ask for a review. And I'll say, why did you buy this product? And they'll look at me and say, I have no idea. And I'll say, well, how does this work? And they'll say, I have no idea. So, life is complicated enough. Try to keep your insurance simple. Don't give yourself extra work to do to kind of babysit a policy. With permanent life insurance, there's a lot of different riders and features, and you really need to read the fine print. So my advice is if you're working with someone and you're not understanding the lingo or you're not understanding the products, get a second or a third opinion. Don't feel that maybe it's you and you don't understand it. It is confusing and you need to make sure you understand it before you buy it. So when it comes to permanent insurance, there's so much that we could talk about. It could be an entire webinar on its own, but very simply put, universal life tends to be the product that is the simplest. Policies can be fully guaranteed till age 120. And policies don't build up cash value, meaning they don't work as an investment vehicle. They're essentially just giving you the most insurance for the lowest cost for your lifetime, which is what most of my clients want. The other three types of insurance, index universal life, whole life, and variable life, are usually designed to build up cash value and give you the option that if you don't want the insurance, you have cash that you can access. You're essentially paying more for that privilege. And what very few people understand is if you pass away and you have $1 million policy and $200,000 of cash value, your family does not get that $200,000 of cash value. They only get the $1 million. So I'd rather you have $1 million policy with zero cash value and $200,000 in an investment account. So again, if you're looking at permanent insurance and you're being told it's a great investment opportunity, my advice is to really dig deep, ask a lot of questions. I usually see the most success by keeping your insurance and your investments separate. And again, some types of permanent insurance are designed to be more of an investment vehicle, more of a way of building cash. You really need to understand if that's something that makes sense for you before you buy one of those policies.
And just to sort of emphasize how important it is to have a trusted person advising you on these things. I honestly have never heard another life insurance broker tell anybody that like they should keep their life insurance and their investments separate because it's frankly, I mean, in the short term, it's just not very good for the agent. And so if they're not really just like they're looking out for you for the long term and investing in long-term relationships with other advisors, they are likely to sell you something that is maybe not the best fit for you. And I've seen actually people, life insurance agents tell me it's better to invest in like a this universal life or whole life or something instead of putting money into your 401k. And I was like, how's that possible? And, and she actually, I was interested to like how does this even make sense? So I had her sit down with me as like, can you go through the math with me to explain exactly how that would be more beneficial? And she did the math. She had a whole spreadsheet and all kinds of numbers and fancy calculations. Um, I, I think well, I'll give her the benefit of the doubt because I think her company explained this to her and it taught her this way. But if you really understood how investments work and how retirement planning works, it was a little bit of like a sleight of hand in the calculation. Most people wouldn't have caught it. Like I'm certified financial planner, so like I have a background in this, but I can very easily see how somebody would say, oh, well, this makes sense. So I just really want to emphasize because it is something that really I think is very common in terms of people not really understanding what it is that they're buying.
And I think just to add, when you go to your doctor and your doctor thinks you have a problem with your skin, he sends you to a specialist, your dermatologist, or to your cardiologist for a heart concern. He doesn't say, let me just do it all for you. So in my opinion, when it comes to insurance, insurance is complex enough. If you're talking about investments, run it by an investment advisor that doesn't sell insurance. Run it by an estate planning attorney that doesn't sell insurance. Make sure that you're getting the person that truly is the expert in that product to weigh in, because it is complicated and you do want an expert. So if someone's talking about insurance and investing, make sure you get a second opinion from someone who does investing as their area of expertise.
Good advice.
This just really quickly is showing you the average dividend or investment return from whole life policies from 1996 to this year. You can see it's a pretty steady line down. Insurance companies don't like to show you this. This is just why I say I think you're going to be better off keeping your investments and your insurance separate. So it's a little inside tip.
Yeah, it's very revealing. And this is another thing that a lot of life insurance agents will not tell you, that they are very happy to tell you that life insurance is tax-free. This is a huge selling point. Life insurance is income tax-free. When somebody receives the life insurance proceeds, they do not have to pay income tax on it. However, it is not estate tax-free. It is in fact, the whole proceeds of the policy are included in your estate. And I've actually had clients argue with me. No, it's not taxable. It's not subject to estate tax. I'm sure of it. I said, no, I'm pretty sure it is. This is what I do for a living. And so it can really affect what you're leaving behind for your loved ones, because the value of your estate is your net worth, so your assets minus your liabilities plus life insurance proceeds. So if you have, especially if you have like young kids, you might have a really big policy to cover, if something happened to you. Say you had, in New York, any kind of property is already worth like $1 million, $2 million. So say you had $2 million net worth, which only in New York, that's not really a lot of money. But then you have maybe like a $6 million life insurance policy because you want to make sure kind of your kids are taken care of, your spouse is taken care of. That's going to result in an $8 million estate, resulting then in an estate tax of close to probably $1 million. So you just want to make sure that you understand that whatever life insurance policy you get, that it will become part of your estate for estate tax purposes. Fortunately, we can remove the life insurance policy from your estate or prevent it from being counted as your estate with something called an irrevocable life insurance trust. And ideally, you would purchase the insurance policy through the trust. And the policy, from the beginning of the policy, once it's purchased, it's outside of your estate. So it never becomes part of your estate. If instead you say you purchased the policy and you didn't purchase it in a trust, you still can put it into the trust, but there will be a 3-year waiting period before it's out of your estate in that case. This is another situation where I find like if you don't have a really trusted or trustworthy advisor on the insurance realm, they are happy to sell you a very big policy without a life insurance trust. And they will not tell you that it's subject to estate tax. And only then when somebody comes to see me, I'll say, oh, you bought a $10 million life insurance policy that's subject to estate tax. Did anybody tell you that? No, I didn't know that. And if we had purchased this policy in a trust to begin with, it would have been out of your estate from the beginning. But now we have to wait 3 years to get it out of your estate. So that's something you just want to keep in mind in terms of when you are purchasing a policy, especially if you're purchasing a sizable policy, that it's often a good idea to purchase it in the name of a trust.
And also, Shannon, I would say we have clients that bought policies maybe in the past and they weren't in a trust and their net worth has grown, and the estate tax changes. And so I would say any client with a $5 million or more amount of life insurance should definitely be getting a review from someone like you to talk about whether they need to now create a trust and get that insurance in the trust sooner rather than later. So just because you didn't need a trust when you bought it doesn't mean you don't ever need a trust.
A very good point. Very good point. Okay, and then and also, especially if you got a permanent policy, then it's much more complicated to move it into the trust. You may have to pay, there might be sort of gift tax implications of doing that. So it's definitely better to get that done from the beginning. Even though the life insurance policy in the trust is not part of your taxable estate, any funds transferred, the way that it works practically is you, once you get the trust set up, you open an account in the name of the trust. You open up a bank account in the name of the trust and you put money into that account, and that account then pays the life insurance proceeds or premiums. Any funds that are transferred into that trust account can constitute gifts for tax purposes, but you can utilize your annual estate tax exclusion for that. So up to $18,000 per person can go into that account tax-free, a gift tax-free, I will say. And if you're married, you can double that amount. I will say if you have a permanent life insurance policy that you're planning on doing sort of more sophisticated retirement planning with, sometimes it can make sense. You're planning on doing that. This can be problematic in that scenario because you really can't use that for your retirement once you put it into an irrevocable trust. Another type of insurance that I think gets a little bit short shrift is disability insurance. I think people do think a lot about life insurance more likely than, but they think disability insurance, it seems like it costs a lot of money. It's not likely to happen to me. Tell me a little bit about how we should think about disability insurance.
So disability insurance is so important because the statistic I think that's most relevant is that you have a 1 in 4 chance in your career of being out of work for more than 90 days due to an illness or an injury. So disability insurance is something that you are very likely to use. You might get disability insurance through work, but it may not be as good as what you could get in the individual marketplace. So my advice is if you don't have disability insurance, please call me or someone like me. If you have it through work, have it reviewed and see if we can design a supplemental policy to strengthen what you have through work. And the younger you get this, the better. The older you get, the harder it is to get disability insurance. So it is something that even if you're not making a ton of money, getting something simple in place that you can lock in and have for the rest of your career is really meaningful. The other thing with policies through work is if you leave your job, that policy may not go with you. So don't go out to start your own company or don't go to a startup and find out that now you're, naked from a disability insurance perspective. Get something small that you can lock in while you're young and healthy and be able to take with you wherever you are in your career.
And that it can apply for life insurance as well in terms of relying on your employer.
Yes, I always want you to own the insurance that you need for your family. personally rather than to have it through work. What you have through work is a bonus, but it shouldn't be what you depend on because it may not travel with you. It may not stay at the same price. It may not really be what's best in class. So again, think of what you get through work as a bonus, but don't use it as a substitute for getting your own personal insurance.
And sometimes the insurance that people get through work is not even the most cost-effective policy I've seen. You assume that, oh, you're getting some kind of good deal because it's through your work, but sometimes it's actually more expensive than what you would buy.
So disability insurance is usually less expensive, but maybe not as good. If you are healthy, your life insurance is overpriced through work because they are giving everybody a policy. So the super healthy people are paying too much because the unhealthy people are getting insurance that they shouldn't be getting. So I've never had a healthy person come to me where I couldn't beat the price of their group insurance offered through work.
So interesting. Okay. Okay, and then also this has become a much, I feel like, bigger concern among a lot of people because the cost of long-term care have been skyrocketing. And so long-term care insurance may be one way of addressing those needs.
Sure. I think many people think I can put this off until I'm older. However, long-term care insurance is something that's great to look at in your 40s, rather than waiting until your 50s. The older you are, the harder it is to get. So the reason my clients are looking at long-term care sooner rather than later is we now have policies that are called hybrids that combine life and long-term care insurance. So if you were to pass away, they work just like your other life insurance policies. But if you were to need long-term care help, having an aide or going into a facility, whether that was at 41 or 81, the policy would provide benefits. So these hybrid policies are becoming really popular because they give you an option, a new option. So if you need the life insurance anyway, why not have this long-term care combined? So I definitely suggest for clients looking at insurance in their 40s, especially permanent insurance, to ask about hybrid life long-term care policies and to see if they are a good fit. But don't procrastinate because the costs of long-term care for all of us on this call will be over $1 million by the time we're in our 80s.
Yeah, it can be really overwhelming.
It can.
So this can definitely kind of give you some peace of mind that that at least some of that care would be taken care of, some of the cost of that care, even if it's not the entire amount, that you have some basic amount of care.
Yes.
Okay, John, we're going to turn to you. I'm sorry, we've been ignoring you.
Quite all right.
You're going to be our star now to talk about property and casualty insurance.
Sure. No, thanks, Shannon. So, I think to kind of start the property casualty side of things, our first slide here is, are there differences between actual insurance companies, right? And I mentioned at the beginning, for anybody that joined late, that, not all insurance companies are created equal, especially on the property casualty side of the business. We see that this business has become commoditized in some ways. But with what we do, for people that successful families that, have financial means and they are growing in their net worth, have multi-million-dollar properties, maybe they own multiple properties and, higher end assets. There are insurance carriers that are catering to that marketplace, far different than what we see advertised on a daily basis that is commoditized, unfortunately, and really built for the masses. Those insurance companies are not what most of our insurers or our clients are going to be happy with in the event of a claim. And there's a number of reasons as to why that's the case. But the first thing is, right, bullet point one here is the actual contract. So what actually is covered by a homeowner's insurance policy? We'll start on the homeowner's side. Where a lot of people are extremely disappointed is when they actually experience a claim and they find out that either whatever the loss may have been is not covered, or it's not covered to the quality that they expect when it's being replaced or fixed. So what does that mean? So the actual contract, the actual paper that the insurance policy is written on is extremely important, and it is in no way, shape, or form created equal across the marketplace. So to kind of give a high level example, a standard homeowner's, standard contract might read that they're going to rebuild your home, whether it's a multi-million-dollar property or not, to quote unquote similar construction. That is a very vague term. So for the custom property that, has, the client has put a lot of money into, or is worth significant dollars to replace, the similar contract, a standard homeowner's policy, they're going to basically replace it to modern day construction. So that beautiful plaster wall that is from the 1800s that you love so much is going to be replaced by today's modern day drywall in the case of a standard contract, as opposed to, a leading high net worth, high value homeowners insurance company that we work with regularly is going to replace, based on their contract, the actual reading of the legal contract, to exact like, kind, and quality. So they are going to replace with the skilled labor and materials that is going to be far more expensive to replace to make you 100% whole, rebuilding to that plaster wall that was from the 1800s on your property. So that's just one example of it. Another really good example is something that I see on a regular basis, which is, water damage or water sewer backup in a home, right? So many of our clients have homes with potentially basements. Maybe they have a sump pump or they have some type of sewer that leads into the property. A standard homeowner's contract does not cover this. And a mass market insurance policy, maybe you can get a additional endorsement added to that policy if the agent is adding it, maybe for $10,000, maybe for $20,000, for a few extra dollars a year, if they add it. It does not come standard on the contract, as opposed to a high-end insurer that will cover it up to the policy limit that you're insuring the house to with part of their standard contract, no questions asked. If there's a significant claim due to your sump pump failure, which we see significantly with large storms where the sump pump fails and now your basement is completely destroyed, they'll cover it up to the policy limit, subject to your deductible, no questions asked. So these are things that our clients learn. Unfortunately, whether, sometimes in the case of they actually have a claim and they have a negative experience, or, working with professionals such as Erin and Shannon on this call that point out that, this is maybe something that you should look at for your property to make sure that the contract that you think you have, or maybe that you haven't looked at in a number of years, is indeed what you expect in the event of a claim. So alluded to the contract, also touches on the claims experience, right? So how do you want to be treated in the event of a claim? Where, the number one complaint I get is, my homeowner's insurance didn't cover what I expected it to cover, or they find out the wrong way in the event of a loss. They end up replacing the home to, basically depreciated value of everything that they own in their property. So, let's use the example of a fire, right? A significant situation, knock on wood, I've only had a few significant, fires in my career. But when those cases occur, they are very large losses. And, a standard contract might read that they're going to replace all of your contents in the house to actual cash value, which is basically we're going to take your couch that you paid $20,000 for, and we're going to depreciate the value because it's 5 years old, and you're not going to get $8,000 for that $20,000 couch to replace it, as opposed to covering it for replacement costs, where they're going to write you a check for $20,000. So a lot of things that go into this. So what I want everyone to take away from this is that they're not created equal. Understanding the insurance policy that you're purchasing, whether it be for the best price, which we think is, the cheapest up front, versus what's actually going to be paid out in the event of a claim. It's really understanding that and being able to talk to an independent broker about what the options are available to you. So you're not flying, through this process with it really not understanding what you're buying. So that would be one. And then that jumps into, advocacy, right? So the property casualty insurance business, I've been doing this a long time. We have never seen a property insurance market like it is today. This is the most difficult property insurance market in 50 plus years. And that's being driven by a number of factors, but, I'd probably see it at this point, on the 6 o'clock news that property casualty insurance for the first time in my career is being spoken about. And the reason that's happening is because rates are going through the roof. Clients that have had zero claims in a lot of cases are being dropped by their insurance companies for no fault of their own. And it's being driven by factors such as, climate change, where insurance companies are going through their books of business and trying to understand where they have a lot of exposure and getting rid of risk that they feel could be negative to them in the long term. Even if there was no claims history there, they're trying the cost of construction to rebuild a home or to replace a vehicle at this point has basically doubled over the last 5 years. So reconstruction costs are up 50% post-COVID. That does not seem to be slowing down. So the house that used to cost $500 a square foot is now costing $1,000 a square foot to rebuild. This is extremely impactful. So an insurance company that used to pay $50,000 for the same claim is now paying $100,000. Well, what does that mean? It's the insurance companies are looking at their balance sheets and trying to understand, how do we continue to make, profit while being able to pay claims of our clients? So clients are being impacted through their rates, through being dropped through non-renewal, and a number of factors just in certain areas of the country where they can't even obtain insurance or obtain it for a cost that is actually manageable. So there is a lot going on in our business. So being able to work with an independent broker, advocacy to talk through, to put you in the best position to obtain the best coverage, that's really where, our strong suit's going to come in, to be able to tell the story for you to not only obtain terms, but obtain terms that make sense for you and your family.
Great.
And then just a couple real quick things to touch on, which is, our clients, as their lives evolve, they get more complex, their net worth builds. There are products out there that most people don't know is available to them, or might see as a significant value as their net worth grows and their risks grow. Personal cyber insurance, which is a huge topic of conversation. So experiencing financial loss due to cybercrime, there is product out there to cover you for these high-end insurance companies. It is extremely inexpensive to purchase, and it's available. So a huge thing to talk about. Flood insurance. It is not covered by a homeowner's policy. It is not just for tidal surge that we see in Florida during a hurricane. It is for water that just can be pouring down rain in the middle of Westchester County, New York. That is a flood loss, not a homeowner's claim. So people are learning these things over time. This coverage is available. It's something I talk about regularly. If you have collections of art, if you have collections of jewelry, are we insuring those appropriately so that if you do experience a loss, your homeowner's policy is not covering it? Do you have those products scheduled, those items scheduled, so that you'll be written a check for the full value so that you can be made whole? If you sit on boards or anything like that, if you have domestic employees, hiring a nanny, whatever the case may be, these coverages, workers' compensation, disability coverage are required in certain states, especially if they're working over a certain amount of hours. So all this can go into the conversations that we have on a regular basis with our clients.
Okay, great. And can you explain to us the difference between, or if there's a difference between umbrella or liability insurance and property and casualty insurance? Are they under the same umbrella, or
Yeah.
are those things different?
No, it's a wonderful question. So liability insurance. So you have a homeowner's policy, you have a renter's policy, you have an auto insurance policy, whatever the case is in your particular situation, you have liability coverage on those policies. And those liability policies will, in most cases, cap out at $500,000. Maybe you can get $1 million under that policy. What that is it's coverage for you in the event you cause bodily injury or property damage to somebody else, right? They're going to come after you personally to be made whole. So it could be a slip and fall at your property. It could be that you live in, a high rise in New York City and you cause water damage to the 3 units below you because you left the faucet running, which, by the way, has happened many times over the course of my career. Accidents happen. Could be a fire that you caused by accident, but you were found negligent in the situation. It could be, an automobile accident where, you cause an accident, 3 other vehicles are now claiming injury, and they're all coming after you. So those underlying policies have liability coverage. So in the case of an auto accident, we'll use that as an example. Maybe you have $500,000 of total coverage. Well, if 3 cars, you're at fault, and there's 5 other, passengers in those 3 other vehicles, 500 grand just doesn't go that far in today's world. They're coming after you for their lost income. They're coming after you for their medical expenses and pain and suffering, whatever the case may be. 500 grand doesn't go very far. The world is very litigious. So what you can buy is an umbrella policy. And what an umbrella policy is it's additional liability, so excess liability coverage that sits above all your assets. Could be your home, your renter's policy, your auto policy, you have boats, whatever the case may be. Any other underlying policy that you have for personal insurance, that umbrella is going to sit above and beyond. So say you have a net worth of $5 million, you want to cover yourself for your full net worth, you buy a $5 million umbrella policy, that auto accident occurs, now you have that $500,000 on your auto policy plus an additional $5 million to cover you. So they're not coming after your personal assets in the event of that claim. Because if there's not enough insurance there, they're coming after you to be made whole. And they can go after your property, your investments, everything else. So that is the beauty of an umbrella policy. The one thing I will say is it is the cheapest insurance you'll ever buy. It is hopefully a policy you never use, but a policy that is more valuable than anything else. So something that definitely want to be talking about with your other advisors. And again, always happy to have those conversations. One of the most common, questions I get is, well, how much is enough? And similar to what Erin talked about on the life insurance side, there is no perfect answer. The answer that I give everyone is, in a perfect world, depending on, how much in terms of assets you have, you want to cover up to your net worth. Well, that's a perfect situation. But at some point, it doesn't make financial sense to cover it to that level. So really the conversation is, what is your net worth? What are your true risks, right? Like, what does your life look like? What is your lifestyle? Are you the guy that, goes up and down in your condo every day and doesn't really drive and, there's not a ton of exposure there, right? But you're worth 50 million. Well, okay, well, it might not make sense to carry that much coverage versus, maybe you own multiple properties, you rent a couple of them out, you have, watercraft that you use on the weekends, you have people over often at your secondary property for, for parties. Well, that exposure is going to be a lot more significant. So what's the likelihood you're actually going to get sued is the question that we want to ask. So I always say, you're going to purchase enough coverage to feel comfortable, and you're self-insuring yourself for whatever your net worth is north of the number you pick. And again, these are scenarios that we talk through. We run the numbers, we look at it, we get an understanding of what your comfort level for self-insurance at some level, and go from there. If you have public profile, obviously that's a whole nother conversation where, you're known, people know who you are. The first thing people do is they Google who they got in the accident with, right? So call it the Google test. So it's one of those things, you get in a car accident, the first thing they're doing is looking you up. So, we want to make sure that we're protecting you from that asset as well.
Yeah. And even if you're not a public figure,
Yeah,
if they look and see, oh, this person's a manager at a hedge fund, well then, okay,
exactly.
be like, okay, there's dollar signs there. We can go after
Exactly.
this person and it'll be worth it. So
Exactly. If you're popping up on the first search, you're an attorney or you run a hedge fund or whatever the case may be, people see that as an opportunity, unfortunately.
yeah. And I'll also just add that there's also other kind of asset protection planning that we can do. Like if you have a rental property, you want to have that in an LLC, there might be some trust planning that we can do, but all of these things kind of work together in terms of the insurance and any other strategies that we might put in place. Okay, so you mentioned this a little bit earlier. We touched on this about kind of what's going on with the with property insurance market. Is there anything else you want to add?
Yeah, no, and I lead with this because it's so important. It's such a topic of conversation right now. It's impacting not just what we call catastrophically prone areas, Florida, California, some of these areas that a lot of us are very well aware that insurance is hard to obtain. It is impacting the entire country at this point. Everyone is seeing, the impact on their homeowners insurance specifically, whether it just be rate increases or something more drastic that I alluded to earlier. So the one thing I would say is, being able to have somebody that's advocating for you, talking about it, insurance companies, it's much easier for them to say no than it is to actually work with you to find a way to make it a yes, right? And I tell people that all the time. Let me tell your story. to put you in the best light to the insurance company, because maybe you did have a claim that caused a non-renewal. Well, was it just because they're looking to get off the risk and they basically said anybody that had claims in this time period for this type of loss, we're just non-renewing you? Maybe. Well, that's a very different story if it was something that you couldn't control, or maybe you've mitigated to prevent that loss from ever happening again. So to kind of talk about, how do you make your risk more attractive to insurers, which is our last bullet point here, is how do you mitigate the chance of that loss happening again? Or if you didn't have a loss, how do I make my house more resilient moving forward? So, something as simple as putting in what we call a water shutoff device, which is a device that can be obtained that is very inexpensive nowadays. In relation to what it used to cost 10 years ago. It's, a device that goes right on the water main coming into your property. And if it detects water is either leaking or flowing at a rate that it shouldn't, it will actually alert your smartphone or go to your central station and turn off the water to the house. The number one cause of loss for insurance companies by a long shot is water damage. So if you can make yourself look good from a water damage standpoint to an insurance company, you're putting yourself well ahead of the game. Not to mention there's pretty significant savings that can be had for putting in these devices. In some cases, 8 to 12%, depending on the insurance company. So it might pay for itself, within a year or two, for even putting it in. So things like that to make our, to have these conversations, to be able to say, hey, this client is willing to put this in. If you give them 30 days, 60 days, all of a sudden there's a different conversation that's being had as opposed to kind of walking into looking for insurance blindly. Which can be very difficult in the market today. So that would be the one thing I would kind of leave everybody with is go in prepared, being able to tell the story and allow an independent broker to do that for you.
Yeah, and I've run across numerous clients who have had issues over the years, and I've referred them to John, and he's done a great job in trying to help them through those issues. But it's always best to kind of start from a good place and
Yes.
have him help you initially if you have policies that maybe you would want a review of. Maybe you can kind of help to do that if you're willing to do that, John.
Always happy to do a review, and I know Erin is the same. Always happy to put a second set of eyes on something at the very least.
Okay, great. Okay, this has run longer than we expected, but I feel like we covered a lot and there was so much valuable information that hopefully people are taking away. But we'll just end with some common mistakes and pitfalls. So I think we touched on this of employer insurance, that you don't want to just rely on your employer insurance, not engaging the help of other advisors. So making sure that kind of like your financial advisor, your attorney, they're involved in these conversations. You want to talk about this bundling to get a special price?
Really, it's just goes back to comparison shopping. Sometimes clients will say, well, I have my homeowners with Allstate, so they're going to give me a discount on life insurance. And then I'll run a comparison and I'll say, but even with that discount, it's still 20% more than what another company might offer you. So don't necessarily rely on a name brand that or a discount from a company you already work with. Usually I'll tell people a healthy insurance portfolio should have multiple companies, because again, there's no one company that does it all right. So if I see somebody with 10 policies and they're all from the same company and they're different kinds of coverage, I know that I'm going to be able to help that person with a review, because they didn't comparison shop when they started. They just went with what was easy. So
Great to know. Okay, so not reviewing your insurance policies regularly. This is something that I think if your life changes or if there's changes in the marketplace, you want to make sure that you are understanding what it is that you have. Anything to add there?
I think we would both say that reviewing your policies every year is a great habit to get into. If you just take a quick look, how is the policy performing? Has my premium gone up? Does this still make sense? When was the last time I had somebody take a look at it? Do I even know where this policy is? These are just things that if you take a quick look once a year, it will help you stay in good shape and it won't become burdensome. I also say if you have permanent life insurance where there's elements that can change, you really have to review those once a year to make sure that they're on track.
Okay, great. We talked about buying a policy you don't understand, so always make sure that you understand it or talk to somebody who will help you understand it. Not keeping a copy of your policy or not making sure your loved ones know about it. Okay, so this is something we see a lot, that we help people with their estate planning and they have a great plan in place, but then, or we don't help, usually it's not us because our clients are not like this. But somebody else has done the estate planning, and then they come to us, somebody's passed away, and they have no idea what any of their assets were, whether they had life insurance or what company it was with. We had to go on a wild goose chase to try to track these things down. And so you really want to make sure that all of these things are organized. That is one of the reasons why we work with our clients. We have a service where we review everything on an annual basis with them to make sure we know like what insurance policy you have, who has a copy of it, or who needs to know about it, who the beneficiaries are. So all of those things, whether it's your retirement accounts, all of these things, it's really important that your family or your loved ones know or know who to call, who will have that information. Okay, not calling your broker before a major purchase or renovation. Overpaying to be underinsured, not working with, we talked about not working with an independent broker. Anything else that you guys want to elaborate on there?
The only thing I would say is just around a major purchase or renovation. You know, I alluded to a challenging market. If you're buying property in, you know, Florida, California, Texas, you know, these, you know, the Hamptons, these high risk areas that insurance companies are pulling back on, call your broker ahead of time before you make any offers on the property. The last thing you want to do is fall in love with a property that either can't be insured or is going to be extremely expensive to insure for maybe a lesser than product. So always good to get ahead of things would be my advice here.
Okay, great. Well, then I think that wraps it up. Importance of policy reviews. And then if anybody wants to reach out to us if they have additional questions, this is our contact information. And I don't think there are any questions in the chat or the Q&A. So hopefully we answered all of your questions, but you can feel free to reach out if you have anything else. And I hope this was helpful to everyone. And thank you so much, Erin and John, for your advice and sharing your wisdom with us.
Thank you for having us. And as John said, we're both happy to answer questions or do a complimentary review. So please reach out to us so we can be of help.